You'll find the link to Crypto Habit Tracker in the description and pinned in comments below. Inflation is stealing your savings quietly, invisibly every year. Crypto promised an answer, but the reality is far darker. In next few minutes, you will see which crypto actually protects wealth. You will see which coins are just illusions. You will learn the exact two-step test that separates safety from ruin. Stay until the end. The checklist is simple. It works. I will take you through the history of inflation. I will expose the myths crypto traders repeat. I will show the three traits that make a true hedge. I will walk through real case studies. I will give you a practical portfolio framework, and at the end, I'll give you the two-step checklist I use before any allocation. If you want clear investigative crypto guides, subscribe now. We break down the noise into what actually protects your money. Inflation is not just rising prices, it is an erosion of future choices. It erodes retirement, education, and emergency funds. Few people realize how quickly decades of savings can lose power. Think of your money as water in a bucket. Inflation makes holes in the bucket. Same amount of water, less when you need it. The consumer price index is a useful measure, but CPI does not always capture real purchasing power for every household. Wages lag behind price rises in many places. That lag can mean a reduced standard of living even with a paycheck. Fiat currencies lose value over time. That loss is quiet and gradual. That quietness is what causes the most damage. By the time people notice the damage is done, some assets can preserve value. Gold historically has been one. Real estate is another. When managed correctly, crypto claims it can be another. But the claim is complicated. Headlines simplify a complex reality. Most simplified claims become dangerous. Sound bites. Bitcoin is digital gold is one of those sound bites. It sounds neat, it spreads fast, but the data tells a mixed story. Volatility is central to the story. For an asset to be a real hedge, it must hold purchasing power during real world price rises. High volatility undermines that practical benefit. If you hedge swings 50% in a crash, it is not functioning as a lifeboat. Correlation matters. If an asset collapses when stocks collapse, it does not provide protection when you need it most. Stablecoins appear safe because they are pegged to fiat, but that pegging means they inherit fiat risk. If fiat loses purchasing power, stablecoins do too. There have been near pegging failures. Some stablecoins have faced liquidity crises that nearly broke their peg. Those incidents are warnings, not exceptions. There are three measurable traits that separate a real hedge from noise. Miss one of them and the asset fails the test. The first trait is scarcity or predictable issuance. An asset that can be inflated away is not a hedge. Bitcoin's capped supply is an argument for scarcity, but scarcity alone is not enough. The second trait is low correlation to risky assets during market stress. A hedge should move independently when the rest of the market is collapsing. The third trait is real world purchasing power. This comes from adoption, utility, or backing by tangible assets. Tokenized real assets can meet this trait if they are audited and liquid. A hedge must float when the storm hits. If it sinks with the ship, it was never a hedge. Now we will apply these traits to real crypto assets. The results will surprise many beginners. First, Bitcoin. Bitcoin has scarcity. Its supply is limited by design. Adoption is broad and growing. However, Bitcoin's correlation with risk assets has sometimes increased during crashes. That mixed correlation makes Bitcoin a maybe, not a guaranteed hedge. Next, stablecoins. Stablecoins are not inflation hedges, they are fiat proxies. They are useful for liquidity and trading. but their peg to fiat makes them inherit fiat risk. Third, tokenized real world assets. Tokenized real assets, estate, or commodity backed tokens can be hedged. They can preserve purchasing power if they are audited and liquid, but many projects claim asset backing without sufficient transparency. Fourth, altcoins and many layer 1 tokens. These are primarily speculative. They often fail during market stress. They are not reliable hedges. There is a real world case not worth noting. A token with centralized minting and poor liquid collapsed during a run. Its promise of scarcity was meaningless because supply control rested with a few hands. The result was a liquidity squeeze and rapid devaluation. People rushed to yield, they trusted high returns without checking risks. They watched hedges evaporate. Protection must come before growth. Your portfolio structure should reflect that priority. Start with an emergency fund in fiat or stable assets. 3 to 6 months of living expenses is a common guideline. This preserves immediate purchasing power without forcing sales in a downturn. Next, allocate to a core hedge. This hedge should meet at least two of the three traits we discussed. It might be a measured position in Bitcoin. It might be a position in audited liquid asset backed tokens. Finally, keep a growth tranche. This is a smaller allocation to higher risk alts for upside. Size it carefully. Do not let it endanger your emergency fund or core hedge. Rebalance on a schedule. Quarterly rebalances are a reasonable starting point. Rebalancing restores your risk profile after market moves. Do not use leverage on hedge positions. Leverage can turn a safe asset into a total loss. Even conservative hedges are vulnerable when margin calls occur. A common mistake is timing and leverage. Two identical portfolios can perform very differently if one uses margin and the other does not. Margin calls can liquidate positions at the worst times. I have seen portfolios implode not from bad coins but from bad leverage. Avoid leverage for hedges. Maintain liquidity to survive market stress. Now we will cover red flags and risk controls. These are practical steps you must take. Red flag 1, anonymous or unverified teams. If you cannot verify who runs a project, treat it with extreme caution. Red flag 2, centralized token minting or unlimited issuance. Token can be minted arbitrarily, can be inflated away. Red flag 3, lack of audits and opaque smart contracts. Audits do not guarantee safety but they reduce avoidable risk. Red flag 4, unsustainable yields. If a yield seems too good to be true, it usually is. Risk control 1, limit position sizes. Decide how much you will risk before you buy. Risk control 2, use reputable custody. Hardware wallets and audited custody providers reduce theft risk. Risk control 3, verify audits and read summaries. Check who conducted the audit and what issues were found. Risk control 4, maintain a fiat emergency fund. This reduces the need to sell during market distress. Use a due diligence checklist before any allocation. If an asset fails any major test, walk away. Now the decisive payoff, the two-step decision checklist. Pass both steps and you can consider allocation. Fail either step and walk away. Step 1 is the hedge test. Does the asset meet at least two of the three hedge traits: scarcity, low stress correlation, or real purchasing power? If it meets two, it passes the hedge test. Step 2 is the safety test. Are there no major red flags? Is the team transparent? Are there audits? Is custody clear? Is the liquidity sufficient to exit in a crisis? Are you avoiding leverage? If the answer is yes to these safety criteria, it passes the safety test. Let us apply this checklist to examples. Bitcoin passes the hedge test by scarcity and growing adoption. It can pass the safety test. If you use reputable custody and avoid leverage, an unverified token promising 20% yields fails the safety test. It likely fails the hedge test as well. This checklist converts panic into calm. It protects your money and your future choices. It makes allocation a disciplined decision rather than a gut gamble. Before we finished, remember the biggest behavioral traps. Hype and fear drive bad decisions. Rational rules protect long term outcomes. Use the two-step checklist before every allocation. Limit position sizes. Avoid leverage. Keep an emergency fund. Rebalance on a schedule. If this breakdown helped you, subscribe now for more investigative crypto guides. We release one deep actionable guide every week. Before you move money into anything, watch our next video on building learning communities and networking in crypto. Learning communities are how you find trustworthy information and vetted deals. Use the checklist. Protect your capital. Stay skeptical but remain curious. I will see you in the next video.